Welcome to our Taking Stock video for the week ending the 8th of March 2024. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Senior Equities Analyst, Jason Yin, to shroom to all things share market. How are you, Jace?
Very good, Ken. Very good.
Thanks for joining us to share your insights today. But before we get started, a quick yet important reminder, the information we provide is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile and in any past performance figures shouldn't be relied upon as a guide for future performance. Well, Jace, the market continues to trade near all-time highs, and that's buoyed by comments from the US Fed Reserve Chairman Jeremy Powell's comments suggesting that there's no reason to expect a US recession in the short term, and that he thinks the US is heading for a soft landing.
Yeah, those are very interesting comments that he's made. But locally speaking, Ken, economic growth actually remains quite soft, with GDP data indicating that the Aussie economy only expanded 0.2% in the fourth quarter, which actually missed consensus expectations. Now, the market has seemingly brushed off this weakness, instead hoping that the weak economic data would actually force the RBA to cut rates sooner rather than later. Currently, the market is anticipating a US rate cut in July and by September in Australia.
Yeah, I guess this is a case of be careful what you wish for. At the stock level, corporate earnings for financial year 24 have been revised lower by about 1% over the reporting season. And you can see this with the chart on screen, which displays the earnings revisions for each reporting season to date. Although much of the downgrade can be attributed to the resources sector, which was weighed down by rising costs, asset impairments, and lower commodity prices, other sectors, such as those in industrials, were not immune as well. And the chart on screen looks at the trend in earnings for each financial year across the industrials. This segment excludes cyclical areas such as resources and financials like banks. As you can see, earnings have continued to drift lower in financial year 24, and this is in the light blue line, yet markets are trading at highs.
Yeah, it's a pretty interesting sort of a conundrum there, Kian. I
Mm.
mean, with Aussie GDP data coming in at 1.5%, we believe the FY22 earnings growth rate for industrials, which is currently around 7%, might be a little bit optimistic. I mean, the market is brushing aside the fundamentals and hoping for that soft landing scenario. And on the back of that, perhaps interest rate cuts as well. I mean, to compound the situation, we've got the impact of passive ETFs, which have actually pushed the price of all stocks, regardless of fundamentals, and has created a bit of a bubble-like environment, especially amongst financially weak businesses. Now, this speculation is no better explained by the latest rally in cryptocurrency, where markets are now testing highs from 2021.
Yeah, there's a lot of speculation in the market, Jace, and with market valuations extended, we are finding it increasingly difficult to look for good quality opportunities following the reporting season as well. In fact, within our star stock portfolios, we suggest it would be prudent for investors to take some profits off the table from those stocks that have rallied quite strongly over reporting season. Those in this category include, say, for instance, RPM Global, Altium, Pro Medicus, and WiseTech. Taking profits allows investors to naturally build up cash levels to prepare for market corrections and also provide them with ammunition to look for opportunities when the volatility arises. Let's now turn our attention to some star stock highlights for the week, Jace. Supply chain company Brambles and also Star Growth Stock, they delivered a strong result, beating market expectations with annualized return on equity at around 25.5%. Jace, Brambles' business is closely tied to the economic cycle. How is the business able to upgrade their earnings guidance despite challenging economic conditions?
That's a good question, Ken. From the revenue perspective, Brambles managed to maintain a double-digit growth rate, and this was due to price increases as well as new business wins. It was also encouraging to see a slight uptick in earnings margins up from 10% to 11%, and this was driven by lower input costs, such as the decline in the price of lumber and also improved operational efficiencies. As a result, management upgraded their earnings guidance by around 4% to between 13 and 15% growth.
Also now turning to the tech sector, utilities billing company Hansen, they handed the market a less than spectacular result. What has led to the downturn in their earnings forecast for the remainder of financial year 24, Jace?
Well, Ken, the core business actually performed in line with expectations. However, I think the market had a bit of reservation around management's latest German acquisition, PowerCloud. We understand that this business is loss-making and therefore represents a drag on overall group earnings for the remainder of FY24, and this prompted a number of analysts to pare back their forecasts.
And I believe, Jace, you met up with the company management this week as well.
Mm.
I like the fact that they still have significant skin in the game, with Andrew Hansen retaining a 14% stake in the business, although he did sell a large parcel in August last year. What were your thoughts after the meeting?
Well, Ken, management are a pretty prudent team of operators, and they've got a long history of well-executed acquisitions. So if you back management, then the recent lull in the share price could represent a bit of opportunity. But if I was to play a bit of devil's advocate, I feel the power cloud business may be rather underinvested, and this could prompt management to inject a significant amount of capital in order to reverse some of those earnings around. I would like to see additional data points in the full year result, and this is why I've kept the stock as a star growth stock for now.
Yeah, all this is in the strategic comments, so please review that.
Mm.
And this week, we removed New Zealand telco provider Spark Infrastructure from our Star Growth stock universe following an assessment of its first half results. Although the business displays high return on equity and net profit margins, Jace, with earnings growth ahead, why did we remove the stock?
Well, Ken, like its Aussie counterpart Telstra, Spark holds a pretty significant market share of around 41% of the New Zealand telecommunications market. It also has a pretty large and mature business with defensive earning streams. Spark is currently investing a lot of capital in the expansion of its data centers, and they're really hoping to capitalize on the cloud technology market. However, from an earnings contribution, the earnings from these data centers remain small and dwarfed by the earnings from its mobile division by at least tenfold. As such, we don't think it's going to help move the needle in the short-term perspective.
That makes a lot of sense, Jason. And we believe the business more accurately reflects the characteristics of a star income stock. But investors may be questioning whether the dividend is sustainable due to its elevated payout ratio at over 100%.
Yeah, so investors should probably focus on the cash and cash flows when assessing the sustainability of these dividends. Management has guided to FY24 free cash flow of between 490 million to 530 million, and this works out to be roughly 27 cents per share, which is in line with dividend forecasts. Now, members should note that management's free cash flow guidance excludes growth capex, whilst the figures in Stock Doctor does include this along with any currency impacts as well.
Yeah, that's why those figures are slightly different to what
Mm.
management has guided. But also, as well, the group has divested a number of assets, just recently been the 70% Connexa sale to the Ontario Teacher Pension Fund for around 800 million. And some of this is used to pay down debt, but around 350 million of this is expected to return to shareholders via buybacks and dividends as well. So the stock is on an unfranked forward dividend yield of about 6% and is expected to go ex-dividend on the 21st of March. Looking at the week ahead, there isn't much in the reporting calendar given that reporting season's over. However, members can refer to the corporate calendar for any upcoming results announcements or ex-dividend dates for stocks within their portfolios. In Under the Microscope this week, we take a deep dive into general insurer and star income stock Suncorp, following our assessment of its first half 24 result and also the positive progress relating to the sale of its banking division to ANZ. Firstly, Jace, what is driving the 10% earnings growth for this year?
Well, growth for Suncorp will be driven by premium rate increases across its home and auto policies, which collectively saw a 12% increase in the first half of FY24. Now, there was also new policy holder growth of around 2 to 3% as well. Additionally, in the first half, management highlighted that insurance margins were pretty stable at around 10 to 12%, and operating costs remain relatively unchanged.
Wow, the business appears quite sound. But the thing is, with increasing frequency of cyclones and floods occurring along the East Coast in the last half, investors may be wondering whether this will impact the group's profitability.
Yeah, natural disasters aren't good news for insurers. So Suncorp has made allowances for a lot of these, and its first half hazard experience of around 568 million actually came in below its $680 million allowance, which is a positive thing. Investors should not be overly concerned, given that wild weather is pretty seasonal, and that second half period tend to see a lot less weather-related events. In addition, reinsurance provides a bit of a cap to the amount of claims that the company could potentially pay out.
Yeah, Suncorp is on a gross dividend yield of about 6.8%. And after ANZ successfully won its appeal with the ACCC regarding the proposal to acquire Suncorp Bank, income investors will be wondering what impact will this have to Suncorp's dividend in the event that the bank demerges the bank division.
Yeah, it's pretty good questions. I mean, ANZ's acquisition of Suncorp Bank will still require approval from the ATO and shareholders as well. It's unlikely to be rejected by Suncorp shareholders or the ATO from a taxation perspective, and is merely a formality. Nonetheless, with an estimated completion date in the first half of FY25, management has reaffirmed the proceeds of $4.1 billion from the sale would actually help fulfill its balance sheet. The impact from Suncorp's dividend profile will also depend on how Suncorp will return some of this capital, whether it's via a share buyback to reduce share count, which could potentially help with dividends per share as well, or maybe in the form of a special dividend so that shareholders can take advantage of those franking credits.
Yeah, that makes sense, Jason. What about for ANZ shareholders as well? The transaction is expected to be earnings accretive over the long term, and this could ultimately flow through to higher dividend payments. However, there are risks associated with the integration, which could impact its profits and dividends in the shorter term. Currently, ANZ is on a gross dividend yield of around 7.3%. With the reporting season finally over, a question that is often asked among our members is, what are our analysts' best growth and income opportunities following the results?
Well, our research team have found it increasingly difficult to identify attractive opportunities, and this is on the back of pretty elevated market expectations. However, there are a few companies we would like to add to our style stock portfolio, but really can't justify their valuations at the moment. Some of these stocks include REA, Lovisa, Audinate, and also Technology One as well.
Also, Jace, within our Star Stock universe, I believe Charlie still endorses Ridley Corp and Endeavour Group as well. Across mining, Daniel prefers his lithium stocks like Pilbara and Mineral Resources. Meanwhile, Ryan, he thinks Challenger will continue to benefit from rising demand for annuity products and growth initiatives.
Yeah, and from my sectors, which includes healthcare, technology, and general industrials, I continue to like CSL, ResMed, and Jumbo Interactive, as well as Objective Corp as well. For income investors, our research team likes the Terra Royalties, Jumbo as well, APA Group, Telstra, Suncorp, and also Endeavour Group. Among the major banks, National Australia Bank has the most attractive dividend yield given its earnings and also its risk profile.
Yes, I think Ryan prefers National Bank and also CBA out of the banks, but those bank yields at about 5% fully franked still look quite attractive. But please read our commentary on these stocks if you'd like more information. That's all we have time for today, and thanks for your insights again, Jace.
Well, thanks for having me, Ken, and I wish you a nice long weekend.
Oh, that's right, Jace. Our office will be closed on Monday due to the Labor Day public holiday in Victoria. But that just means that we'll be running Lincoln Live on Tuesday. So feel free to come along to that event. Also, a reminder about our masterclass event in April. There are only limited tickets available, so make sure you reserve them as soon as possible. In the meantime, take care and have a happy, healthy, and prosperous week ahead.